This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. Welcome to the Wealth Roundup for the week of June 12th, 2026. I'm Terry Evans, along with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Patrick, after having a little hippie shake done and ready to go trepidatiously on your recovering hip. I'll tell you one thing, though, Patrick. Since we have taken that little bit of a sabbatical while you had your procedure done, it looks like the markets have been kind of in a paint shaker over the last 2 to 3 weeks. Would you agree?
Yeah, I agree. Yeah, I agree. And I should clear this up since you're talking about a little procedure, Terry. Hip replacement. Just so the audience knows, all good. So yeah, usually when I take a break, so take a nice holiday, the markets are usually kind to us, and we've had a little bit of both. We probably had 2 weeks where the markets ran up to some new all-time highs. And then we've had a rough, certainly last week in the markets. And so what I would say, to put it into the context, is the markets are having a hard time holding on to what we actually came out with back in December as our 2026 targets for the TSX and the S&P 500. So our targets were 34,500 on the TSX and 7,500 on the S&P 500. And both of those indices are now off about 500 points or more from those index levels. So sitting at about 6.8% year to date for the TSX and about 6.25% for the S&P 500. Both of those down about 4% in the last week. So pretty big change. And I would say skepticism is the primary reason for that big change in those valuations. And I think that skepticism is twofold. So skepticism on a deal in the Middle East, which seems to just move back and forth, tug of war. We have a deal, we don't have a deal. We're working on a great deal. And then all of a sudden, nothing happens. And then the other skepticism would be, what's happening in the continued build out of AI. And so those are things that the market is having to deal with. And then there's lots of macroeconomic factors that kind of surround all of those things. So I think, being at the halfway point for the year, 6 months in, to be just kind of hovering around our full year target, while it would seem like there's lots of uncertainty, is that really we're very much in line. In fact, probably slightly better than what our expectations were for the year.
Seems to be a lot of turbulence with AI, like you mentioned, chip makers and whatnot worldwide. And then there's Canada as we narrow in a little bit. Canada is in kind of a technical recession. Is that the case?
Yes, absolutely it is. And, as it kind of plays out on the political front, is that, it definitely kind of is calling into question, what the Carney administration is doing about the economy. First of all, we shouldn't be surprised. We're just slightly a year removed from Liberation Day. So slightly a year removed from starting effectively a trade war or an economic spat with our largest trading partner. So while going into Liberation Day, Canadian GDP growth would have been some number with a 1 in front of it. I guess we shouldn't be surprised that now we've connected 2 consecutive quarters of negative GDP growth. And yes, you might hear kind of the talking heads on the media say, oh, those numbers might get revised, and we might find that we're actually not in a technical recession, but those numbers could get revised and we might find we're in a deeper recession, with the revisions. So safe to say that the Canadian economy is going through a period of weakness. And, if we look at what a lot of the discussions are regarding the Canadian economy from the West Coast to the East Coast, from our southern border to the north, is the plan is to basically retool the Canadian economy, and I think we're in the very, very early innings of what that might look like. Obviously, diversifying our trading partners and spending a massive amount of money on infrastructure and sectors like defense. And so those things are going on. I think there's an economic plan in place. But to be honest, I wouldn't be surprised if this is a story for the remainder of the year and well into 2027, maybe before we see the benefits of that. Now, there's one really other important piece of economic data that did come out at the same time, or a couple days after, is a spike in job growth in Canada. Now, hopefully those numbers hold, but we saw over 80,000 new jobs created in Canada in the last week. Now, that was, that would be really positive, because we've talked about this extensively on the Wealth Roundup, is that Canadian unemployment has really lagged unemployment in the US. Our unemployment rate has been close to 7%, whereas the US unemployment rate has been closer to 4%. So that might be the early signs of perhaps these new opportunities percolating through the Canadian economy. But a recession always makes investors nervous. And so there's, we shouldn't be trying to hide the fact that, the Canadian economy is weak. We should be talking about what we're going to do about it.
Well, that's what I was going to say. Is there something that investors should do? Should we be bracing ourselves? Should we be, hanging on to a supporting post?
Yeah.
Or should we be all saying, "Hey, this is tremendous opportunity"? How should investors respond or react?
Yeah. So, well, I think the first reaction is that there's probably a bit of a disconnect. Most investors are saying, "Well, recession, okay, but I'm looking at my investment portfolio. I'm doing pretty good." So, difference between, say, an economic recession, negative GDP growth, and a bear market in stocks. So, we haven't seen that bear market in stocks. For the most part, stocks have performed very well, certainly within our expectations. But the recession would indicate that, often what comes with recession is declining employment, right? Is that, the economy isn't doing as well. Businesses are having to lay off employees. Businesses are having to retract investment. And so that's not what we're seeing here in Canada. If we believe the job numbers that come out of the Department of Labor and Statistics, and we believe in, the national projects program, where we're investing, new money, and we're creating kind of new relationships, new trading partners, then we're maybe not seeing what tends to accompany a recession. Is, there are perhaps some things to be excited about. So now I think the other thing, and again, I'm not saying something that you can't find in the news, is that there are going to be, armchair experts and professional experts out there saying that there are some warning signals about, the Canadian economy, the U.S. economy, global economy. I think Bank of America came out just this morning and said, there's some red flags out there that the U.S. economy is perhaps started to see some deterioration, and in their model, perhaps getting closer to a recession in the United States. BMO capital markets, we don't see that right now. We see, continued, growth in the U.S. And here in Canada, is that we don't really think that there is a need to do something drastically different, assuming you're an investor that has a diversified portfolio where you have set your asset allocation, your mixture between cash, fixed income, and stocks, appropriate to your risk tolerance, and that you've got your time frame right. And as we've often talked in the podcast, that you've got your cash flow set. The money that you need to be there when you need it to be there, is that you know where that money is. And so I don't think that there's any necessity right now to do anything different based on that announcement last week.
We record the Wealth Roundup generally on Tuesdays, and then it's released late Thursday, sometimes Friday. By the time this is out for people to consume, the Bank of Canada will have come and gone with their Wednesday rate adjustment, if there is one. What is the thing as we move forward with that, as far as the Wednesday Bank of Canada rate?
Yeah, so Bank of Canada tomorrow, U.S. Federal Reserve next week. Our expectations for the Bank of Canada for this year were to stay on hold. Our expectations for tomorrow is to stay on hold. Now, what will be interesting tomorrow is that the Bank of Canada will likely address, maybe not directly, but for certain indirectly, the status of the Canadian economy. So there's usually, a big debate in terms of the additional commentary that comes around the actual rate decision itself. So perhaps along with the rate decision, there might be a hint of what the Bank of Canada is thinking for the future. And so, our feeling is it makes sense for the Bank of Canada to stay steady. The Bank of Canada is benefiting from its strategy years, in the previous 2 years, cutting interest rates ahead of the U.S. Federal Reserve's plan for cutting interest rates. And for the most part, inflation has remained more contained in Canada than it has in the United States. Probably because the economy in Canada is not growing as fast as it is in the U.S. But we will be looking for perhaps those other hints in terms of, and then what the market reaction is to that additional commentary, and we'll probably see that play out with what happens with bonds. So, if following tomorrow's decision, the feeling is that the Bank of Canada, might consider an interest rate cut later in the year, which again I don't think they will. Is that we might see longer term interest rate yields in Canada kind of come down. We'll see that play on the bond market. So we'd see bond prices, reflect that. And in the U.S. is that we're already kind of seeing that the expectations were this year is that early on in the year is that the U.S. is going to be cutting interest rates probably 1 or 2 times. And now we're not sure if the U.S. is going to be able to cut interest rates this year. The higher inflation in the U.S., so we do get a CPI read, so U.S. inflation read tomorrow. That'll be interesting data to get. But already we're looking at longer term, so 10-year U.S. government bond yields. So bond prices are down, yields are higher. That 10-year U.S. bond yield now is sitting at around 4.5%. So it's moved up quite a bit this year because the likelihood for a cut, a U.S. interest rate cut, is slowly looking like it's coming off the table more. That's probably kept the U.S. dollar stronger. Probably one of the reasons why gold prices are down off their high is that there isn't this weakness in the U.S. dollar that we were expecting late last year.
For wealth management and to start your investment journey, you can find Patrick's contact info at www.patrickmleonard.com. And that's episode number 45 of the Wealth Roundup for the week of June 12th. Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Thanks, Patrick.
Thanks, Terry. Have a good week.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.